Good afternoon. On behalf of the AICPA Technical Issues Committee, I'd like to thank the FASB for allowing us to come here and meet with them today to talk about issues facing private companies. We always look forward to our opportunity to come out here and meet with you and provide you with our viewpoints of what we're seeing in practice and hearing from our clients and seeing in our firms. So, Rich, thank you so much for letting us come out here.
Well, Kurt, I really think it's us that should be thanking you. We invited you here on a Friday afternoon to discuss all the topics of interest from an accounting perspective with us. But seriously, thanks very much for taking time out of your busy schedules. We know you all have lots of other demands on your time, and we greatly appreciate the fact that you'll dedicate your time to share with us your thoughts as we work together to improve financial accounting and reporting. Jennifer?
We're going to do a round of introductions. So if you can just say your name and your organization, and I'll start. Jennifer Weiss, FASB staff.
Kurt Hurd with TIC and with Plant Moran.
AJ Bowers, Carr Riggs and Ingram, and the TIC.
I am Jack Day, Technical Director.
Christine Bodison, FASB.
Andrea Kalady, Baker Tilly, and TIC.
Jessica Boycor, I'm with TIC and with Kat Sepper Miller.
Max Habercorn, I'm with Ruben Brown and the TIC.
Sheila Balzer, I'm with TIC and with Singer Lewack.
Paul Helfer with Brady CPAs and TIC.
John Hansen, I'm with Eid Bailey and with the TIC.
Hi, I'm Sue Cosper, FASB.
Good afternoon, Katie Alcalady from Clark Newber and TIC.
Hi, Nellie Debler, FASB Deputy Technical Director.
Sam Steigenberger, FASB PTA.
Caitlin Murphy, FASB PTA.
Jerry Shawver, Private Company Council Chair.
Hi, Adriana Yepes, FASB staff.
Ashley Allen, FASB Practice Fellow.
Erica Fend, FASB staff.
Tiffany Wiskowski, FASB staff.
Afternoon, Andy Renzel on TIC with Forvis Mazars.
Kat Peterson on TIC with Armanino.
Hillary Salo, FASB Vice Chair.
Hello, Sarah Kurtz, TIC and with Eid Bailey.
Jennifer Gum, TIC AICPA.
Melanie Barthel, TIC and Johnson Lambert.
Brian MacDonald with TIC, Clifton Larson Allen.
Joyce Joseph, FASB member. And Rich Jones, FASB.
All right. The first topic on our agenda is an overview of the FASB agenda consultation. So we'll turn it over to the staff to give us an update.
Thank you. Good afternoon, everyone. So in September 2024, we met with TIC as part of our kickoff for our agenda consultation process. And there we asked members really just open-ended question of what should the board work on next? That discussion was part of a broader outreach effort where we talked to over 200 stakeholders, including investors, preparers, practitioners, academics, to identify those priorities. The feedback that we got through that broader process was then included in our invitation to comment document. You see the picture of it up on the screen, which was issued in January of this year. And as a reminder, an invitation to comment is a staff document. It doesn't have any board views in it. So really the content of that invitation to comment was all the feedback and all the topics that those stakeholders identified as priorities. And the comment period on that document ended on June 30th of this year. On the next slide, you'll see we received 129 responses to the invitation to comment. This includes responses from comment letters, advisory group and liaison meetings, as well as other stakeholder outreach meetings through the end of August of this year. You can see from this pie chart that it really came from a cross-section of users, including investors, preparers, trade groups, practitioners, and others. And they also represented a wide variety of industries, including financial services, insurance, oil and gas, pharmaceuticals, energy, environmental, crypto, just to name a few of them. So we wanted to go through today just to highlight some of the feedback that we heard. There's no way we could go through all of the feedback. We would be here into well over the weekend. So we're just going to highlight at a high level some top priorities, some low priorities, and how that may intersect with the priorities that TIC had in their letter. So the next slide gives you a high-level overview of just a few select topics of what stakeholders concentrated their feedback on and how they prioritize topics. So this highlights its percentage of total respondents. There was a wide range of perspectives received across topics. While some topics were consistently identified as either a top or a low priority by stakeholders, others received much varied responses, with views really split between top and low priority. Also, even though some topics were consistently identified as top priority, there was also a wide variety of feedback of how the board should address those issues. You can see that topics like enhanced disclosures, distinguishing liabilities from equity, and equity method accounting received fairly mixed feedback. Conversely, respondents seem to be more generally aligned on other topics such as risk management and hedge accounting and outdated disclosures, and really that they should be a top priority. However, as I mentioned, stakeholders identified things like risk management, hedge accounting, and outdated disclosures did provide a broad range of how the board could move forward with that. And lastly, stakeholders seem generally aligned that other topics, such as recognition of interest income, estimate of variable consideration, and pushdown accounting, should be low priority. So the next slide highlights the most frequently identified top priorities for three of our larger stakeholder groups. As you can see, there are differences among these three groups and what topics the board should address. And while investors and investor advocate groups really focus their feedback on ways that the board could enhance disclosure of financial reporting information, practitioners and preparers primarily identify topics where they think targeted improvements could be made to reduce unnecessary complexity or reduce diversity in practice. So topics that TIC identified as top priority, specifically distinguishing liabilities from equity and troubled debt restructuring, are included in these top priorities. And additionally, troubled debt restructuring, or TDRs, includes feedback that we received on debt modification and extinguishment accounting, which TIC also identified as a top priority. So the next slide highlights how the topics that TIC discussed in their letter, and it shows you really two things. It shows you the volume of the feedback, so the wide kind of breadth of feedback that those topics got, as well as it tells you top, low, and neutral priority. So you can see that on this chart, yellow indicates low priority, blue in the middle is neutral, and green indicates top priority. On this and a few others that you'll see, we really have neutral in there, in that stakeholders didn't necessarily say this was a top priority or a low priority for the board to address, but they were open to standard setting if the board decided to address the topic, and they provided several suggestions for those topics. So some stakeholders identified the same topics as TIC for top priority, including distinguishing liabilities from equity, definition of a PBE, and troubled debt restructurings, which included debt modifications and extinguishments, as I mentioned. Well, there were other stakeholders that also agreed there's other topics that TIC identified as low priority that it should be, such as ESOP repurchase obligation disclosures, definition of cash equivalents, and statement of cash flows, as well as enhanced disclosures. So you'll see wide variety of feedback. I think you'll see that as a theme. So I wanted to go through, moving on to the next slide, as a reminder, the ITC was organized into 8 chapters. And this really grouped the topics that we heard the board should work on into broader areas, such as combination of entities or financial instruments. And we also received feedback on the research agenda projects. So on the following chapter slides, we've included some feedback that we received from stakeholders that gives you the breadth of the feedback we got, as well as the priority. And so I'm just going to touch on a few observations on each slide to give you some perspective. Chapter 1 included topics related to combination of entities. So here I'd say equity method received the highest volume of feedback out of all of these topics, receiving actually fairly high volume across all topics that we got. And there was mixed views here on whether the topic should be addressed, and if so, how the board should address it. Interaction of consolidation guidance and other transactions was pretty high top priority in this chapter. And this included mainly feedback we heard on aligning the guidance for asset acquisition and business combination. And then definition of common control received mixed feedback, and pushdown accounting was generally a low priority among stakeholders. So chapter 2 included several financial instruments topics. Risk management and hedge accounting, alternate funding arrangements, and distinguishing liabilities from equity were among stakeholders' top priorities for this chapter. And for these topics, there was many suggestions provided on how the board should address them. Alternative funding arrangements specifically was primarily identified by stakeholders in the pharmaceutical industry to focus on royalty monetization arrangements. And additionally, stakeholders provided feedback on the definition of a derivative and derivative modifications, which was discussed yesterday between TIC and PCC, including feedback we received on embedded derivatives in this chapter. So very similar feedback to the discussion from yesterday. And some stakeholders for that area noted that the bifurcation requirements often involve significant judgment and suggested several approaches to simplify that. Chapter 3 included topics related to intangibles. This was a smaller chapter. Primarily here, crypto assets was the top priority of this. And this was really doing items that are beyond the last crypto project. And there was a project for digital assets on the research agenda that was added after the issuance of the ITC. As far as chapter 4, this included really other assets and liabilities that weren't included in the previous chapters. So this is kind of a random mix of other assets and liabilities. Here I'd see the definition of cash equivalents. You can see received the most amount of feedback, but stakeholders were mixed on that. And asset retirement obligations were the top priority for this chapter, particularly where stakeholders suggested the board consider changing recognition or disclosure requirements to provide more transparency about unrecognized obligations. Chapter 5 had topics related to retirement and other employee benefits. This, I'd say, across the board, these topics were generally low priority by most stakeholders that discussed them. So I'd say these were not, a few had top priority, but most indicated that these shouldn't be a high priority for the board. Chapter 6, the next chapter, had several revenue topics and some others. Of these, which some probably doesn't find surprising, is that principal versus agent considerations was the top priority. And this is really just the same feedback that stakeholders provided in the past, that this area of gap continues to be challenging. And the remainder of the topics were generally low priority, with just principal versus agent coming out fairly high. Chapter 7 included several topics related to presentation and disclosure. And this mostly included topics that investors had identified as top priority in that outreach that we did leading up to the ITC. This includes enhanced disclosures and outdated disclosure being the highest priority for stakeholders within this chapter. And I'd say here, investors generally agreed that the board should enhance disclosures as a top priority, although there was a wide variety of suggestions of what those enhanced disclosures should look like or be. But preparers, I'd say, generally agreed that the board should rather, instead of add any incremental disclosure, they should rather revisit outdated disclosures, such as fair value disclosures or derivative disclosures. So I'd say mixed feedback on both sides for those topics. And the final chapter was related to current research agenda projects that were on the agenda at the time of the issuance. And this really asked for some more direction and paths forward for these topics. I'll point out here, statement of cash flows received the highest volume of feedback out of those topics, with many stakeholders agreeing with TIC that this should be a low priority. However, others said it should be a top priority, and many stakeholders provided suggestions of different target improvements or an overhaul to the statement that the board could do there. So that gives you kind of a flavor. It was very high level and a lot of information, but gives you a flavor for really the breadth of the feedback that we got. So on the next slide, this is going to look like a lot on the screen, which is why we're not going through it in detail. Don't worry, we're not going to sit here line by line and tell you all the feedback, but this really is all the topics that were in it. There was 42 topics in the ITC, and it shows you, really, it illustrates the volume of the feedback that we received, as well as the diversity of the feedback. And kind of to conclude, as far as next steps, the staff is in the process of summarizing this feedback for the board, which will be presented at a public board meeting this fall. The board will then take all of that feedback and analyze it against its agenda decision criteria as part of a broader agenda prioritization process, and then it'll decide how to make changes to the agenda. And once the board has completed considering all the feedback, it'll issue an agenda consultation report, which will summarize how the board took the feedback into account and what changes were made as a result of that. So with that, I guess I'll turn it back over to Kurt we have questions for TIC members. And we want to say, what are the observations or questions from the stakeholder feedback on the priority areas? And for other areas, what other other feedback or observations you have. Before I turn it over, I just wanted to thank TIC too for their comment letter and their feedback. Thank you.
Well, thank you to the staff for putting that together. I know these letters came in fairly recently, so getting all this pulled together in a short amount of time is not an easy task. And so we appreciate being able to see the feedback that you've received on this invitation to comment. I guess maybe a question on some of the stakeholder feedback, just maybe on some of our higher priority areas, just maybe getting a little bit of a better understanding as far as what type of feedback you may have gotten on like the distinguishing liabilities from equity guidance, as far as it looked like from the practitioner viewpoint, that was a pretty high priority, but maybe not so much for investors or preparers.
Sure, happy to answer that. So I think for distinguishing liabilities from equity, as you saw, there's mixed feedback. A lot of practitioners had prioritized as top priority. I think the questions that the ITC asked were, would you be comfortable with more instruments being equity? And then what target improvements should it focus on? For example, the indexation or the settlement guidance. I think overall the feedback here was that generally stakeholders thought they were okay with more instruments being in equity. So I think that was important feedback. And then I think also they did say kind of focus their efforts on the contracts and entities on equity scope exception guidance, and that indexation is potentially the highest priority to fix, that there is challenges that continue on with that.
Nellie?
Okay, sorry, I was looking at Jerry, but it's not your meeting, I'm sorry. One thing I just did want to add about the relative priority among stakeholder groups is if you look at the preparers that responded to the ITC, some, but not all of those are relatively larger, relatively more sophisticated entities. And so I think the feedback from TIC is really helpful about how this topic is viewed by other types of entities. Your client bases, that's very relevant to us to hear that it's important to those entities. We get similar feedback from time to time from the PCC. So that's something that I think we'll keep in mind as we process this feedback that could lead to some of the differences in prioritization among stakeholder groups.
Jessica?
I think along that vein, and PCC probably asked a similar question, but in terms of the feedback, how much of it was related to private companies providing feedback specifically on some of these areas versus public company feedback, especially as we looked at, some of the enhanced disclosures and who the users are and some of the higher priority items, for our interest group, are there things that private companies were tending to respond on or more so than maybe, to Nellie's point, the larger entities that may be outside of our purview?
I'd say we're still in the process of analyzing the feedback and kind of bifurcating it that way. I'd say there wasn't a significant amount of private company specific feedback. Maybe like a troubled debt restructuring was one, distinguishing liabilities from equity. Some identified it's a bigger issue for private companies. There was also some stakeholders that mentioned topics that either the PCC should work on or we should consult with the PCC on and get feedback from them. So I'd say that'll kind of all be part of as the board starts to consider the different topics and whether and what capacity they should work on that. That'll all be considerations that will be taken into account.
Thank you. Yeah, and I think just maybe to add a little bit for the distinguishing liabilities from equity, I think probably similar feedback that you heard from some of the large practitioners working on public companies. Those issues a lot of times get magnified in the private company space. Just they don't see these type of guidance very often and don't have accounting policy departments to help work through those things. And so there's a lot of work that goes into kind of coaching them through understanding, well, there's different models that you need to go through when depending on the nature of the underlying contract, and then how to work through the indexation guidance. And so some of those nuances in that can be confusing. If they've seen it for one type of instrument, they want to apply that to a different type of instrument. So if they've done it with convertible debt before, then they issue an equity contract like warrants. They think the analysis is the same when there's different models that need to be followed. And sometimes they come to different answers. And so that's an area that involves a lot of discussion with the clients as we work through that with them. Rich?
Sure. And maybe just, I won't make Sam go back to the slide, but the very busy slide that Erica showed you where we had, lots of green, lots of yellow, particularly on the same items. One of the things that our team's working through and we as a board will consider is even where there was green, it didn't mean people had the same answer. But there are some similarities. So if you think about liability and equity, I think the point was made, Erica talked about, was there a tolerance for more in equity? That resonated with investors very often because if it's an equity, it doesn't go through their income statement. And it resonated in that the complexity in the model was driving things to liabilities, very often based on almost hidden features, right? Or features that were less likely to be really driving the overall economics of the instrument. And so there was some common ground there. And that's part of what we're doing as part of this process. If anyone thinks standard setting is easy, the different colors probably point out, no, not necessarily, but by the same instance, the green doesn't mean a universal agreement either. And that's why the continued outreach with your group and others is very helpful to us as we bring these items back over the next several months.
Hillary?
Just specifically with regards to liabilities and equity, and agree, right, we heard some interest of having more things in equity classification. But of course, we can only control equity classification that we control here at the FASB, right? There's specific guidance for the SEC, which ends up with some things being in temporary equity. It'd be helpful to understand how often you have clients that are applying the SEC guidance, if at all, with regards to temporary equity, just as we kind of think about what are those potential solutions for addressing this guidance.
In my experience, and interested in anyone else on TIC's viewpoints as well, it's very rare for an entity that's not subject to the SEC's guidance on temporary equity to voluntarily apply that. Are there any other topics that anyone else on TIC would like to give a little bit more detail on? Katie?
I wanted to mention we didn't have equity method as one of our top priorities, but we were talking a little bit more about it this morning and it was probably just below those others. So we still felt that was a very important topic and one that definitely warranted more looking into. So I was curious as to, it is a top priority for a number of respondents, but what kind of feedback were you getting and what kind of suggestions?
Sure. Yeah, equity method was under disclosures. It was the highest, you can see there, under disclosures and cash flows, that it was the highest amount of feedback we got. I think the feedback we got there is that equity method is challenging for some. And although it's challenging for some, it makes sense for some entities. So I think the question that we asked there was, should equity method investments just be accounted for under topic 321, consistent with other equity securities, which would include the ability to elect the measurement alternative to be at cost minus impairment. And I think the feedback we heard there was mixed. Not surprising considering the theme, but I think some said that would be helpful, eliminating the equity method and putting all equity method investments like equity under 321 would be helpful, while others said that, for some, the equity method makes sense. Maybe for some, maybe I'll call it like strategic investments, the equity method makes sense. And so some suggested an option to be able to apply topic 321, mainly to be able to apply the measurement alternative under that guidance. We also heard some potential target improvements if the equity method were retained, such as looking at the accounting for basis differences and some of the more challenging aspects of equity method. So I'd say we heard a really, rich variety of feedback there.
Yeah, I was just going to say that's consistent, I think, with a lot of the feedback that we had. So thank you for that.
Hillary?
Maybe just a follow-up question on equity method, right? We've talked about whether or not the measurement alternative would be a potential solution. But I think we've also heard feedback from other companies that applying the measurement alternative is not without cost, right? Trying to find what's an observable transaction. And so I just had a question for the group of whether there are challenges in applying the measurement alternative today, and if you would foresee those similar challenges if you were applying this more broadly, right, to equity method investments.
There can certainly be some challenges. I think one of the challenges you can see is trying to identify if there's been an observable transaction or other times when it's an entity that does multiple rounds of financing, trying to determine, well, are these subsequent rounds really representative of the equity that we hold as an entity holds? Because it's like, well, if those rights and privileges are different, that may not really provide observable evidence of the value of that. And so it doesn't eliminate the cost, and there's still cost involved in assessing that.
Do you think that's reasonable cost? I mean, an entity that does multiple rounds of financing, right? Effectively, we're saying you don't have to go out and separately value it. You can look to those if they're similar. Is it a complexity, do you think, of the transactions, or is it a necessary complexity in the accounting model?
It seems a bit to be a necessary complexity. I don't know how you'd be able to write it to eliminate all of the complexity. So I think it's an important concept as far as marking it up when there is an observable transaction, because that is giving the user, in those instances where say it's the same round, that's much better information to have instead of say, well, we know this is either at a higher value, but we're not going to write it up. Doesn't seem to be doing providing good information to the users. And so I think it seems to be unnecessary complexity, and it's not hasn't seemed to be an undue cost, but it is a cost. Maybe another topic, and I know you heard about it probably with the PCC this morning, but obviously one of our high priority items was TDRs and debt modifications. And so I'd maybe just understand a little bit more what some of the feedback was around that.
Sure. The feedback I'd say around troubled debt restructurings or TDRs by borrowers and debt modifications, extinguishments, I think we heard a few things. I think we heard that it doesn't make sense sometimes to have multiple areas of gap in order to apply it. I think what we heard, we asked, how frequently does it end up in TDR accounting? And I think most said that it doesn't, you have to go through TDR accounting, but it doesn't end up being actually accounted for as a TDR, although that could be dependent on the economic environment. And I think they said generally it ends up being accounted for under modification and extinguishment accounting. And then I think consistent with the feedback that TIC had is that, merging some of the extinguishment and modification accounting and simplifying that a little bit would be helpful.
Sheila?
Thank you. My comment on that, just because I work in the financial services industry, as it helps to prioritize agenda topics, I think the debt modification and the TDRs for borrowers is a real issue that people are dealing with now. So any consideration that can be given the economic environment, I think would be important to do sooner rather than later.
Rich?
Just curious on that. I mean, so, TDRs, you tend to, my experience was you tended to know them when you saw them. And then we had extinguishment and modification. Is the sense, so say, for example, some suggested eliminating TDRs. Is that coming from, nobody really likes to tell somebody they have a TDR because it's almost like telling them they have a going concern, and it raises all kinds of conflict, let's say, in the discussions? Or is it because people think that TDR accounting is bad accounting? In other words, the TDR accounting, right? I owe you $1 million. It's paying in 10% interest rate. The lender usually doesn't forgive my principal, right? They just lower the interest rate and we move on, right? And the lender's just trying to get their money back, has generally been my experience. If we were to get rid of TDR accounting, very often that's going to be an extinguishment, which means a big gain and then a very high interest rate. Do people think that's better accounting? Or is it just to get rid of one of the models? Any input you're hearing from your client base would be helpful.
Sheila?
I think I would lean towards it's getting rid of the model. I mean, yes, there's a negative connotation when you see TDR, and but I also think it goes back to actually a little bit different perspective is the accounting systems, because, you know, as we all grew up knowing, once a TDR, always a TDR. So having to kind of deal with that differently, and whether or not the sophistication of the system at a financial institution smoothly deals with that, I think that's one piece. But I think more than that, it's how did the regulators view it while you're, you know, required to prepare your financial statements in accordance with GAAP. If you look at a lot of the regulatory reporting, they talk about if you have a modified loan and the loan performs for 6 months under the modification, it kind of falls off some of the regulatory reporting. So I think there's some difference there. I agree with you. Most of the time, if you're probably talking about a modification, there's probably some whiff of financial difficulty, right? This isn't the borrower that is stronger and is, you know, really doing a true new loan to change rates or something like that. Like I said, usually they're forgiving part of the rate or extending the term of repayment. I think it would be I worry about this, like, quote, large gain or something reporting as, you know, does that somehow mask the fact that there's other financial issues going on? So I'm not sure I know or could say what model I think is best, but I think some of the difficulty is actually rooted in systems and regulatory issues, in my opinion.
So I guess the good news is we got rid of TDR accounting for the lender.
You did,
already.
yes. And I
And
say
so-
that all the time.
So we're
Yeah.
only talking about the borrower,
Right.
right? So the individual, and they only have one, and they probably don't have a lot of regulatory reporting, right? They just have the reporting to
Sorry.
to their bank.
Yeah.
So there it, you know, I just think about it. I mean, you don't have to answer here, but if we did get rid of TDR accounting for the borrower, it would likely drive gains and very high interest expense. And we've always had a little bit of a hesitancy in accounting to book a gain and give it back. And that's effectively what we'd be doing. And if you said, no, you don't like that accounting, interestingly enough, you get right back into TDR accounting. So is there a different, is it just that there's three models? Is it that I can, in my old client service days, going and telling a client they had a TDR was never an easy message any more than telling them you were giving them a going concern. Is it that? And, you know, maybe we could call it something else, but maybe it would still be that model. So just as you guys do your outreach, we'd be interested.
Sheila?
And I apologize, Rich, you did catch me because my practice is on the lender side. So sorry, that's where my brain lives. But well, the other interesting thing, if you look at the debtor side, right? You know, a lot of times in private companies, it's the lending, whether it's bank company or whatever, that are requiring the audited or reviewed financial statements. And so therefore, in my experience, the lender is well versed in what's going on because they analyzed all of that as part of deciding whether to do a modification or whatever it was. So and I miss my friends, the bankers from the PCC, but I'm not, so then I wonder how useful is it, like you said, to have a large gain and large interest expense when the primary user, at least a lot of times being the bank or the lender, already knows what's going on, right? Yeah, so instead of a TDR, maybe you could have a respectfully submitted modification in response to financial issues, you know, or something. But so when I switch my perspective to the borrower, it's if they're giving the financial statements somewhere because the lender will know all of this, right? So so I guess from that perspective, unless they're submitting the financial statements in the private company world elsewhere, do we need to be worried about the fact that the connotation of troubled debt is disturbing. I think people don't like it because obviously business owners don't like to view themselves as a going concern issue or a troubled something or other. So like you said, it could be very, very well psychological in that respect.
Jessica?
I think in my experience, this started coming up more in a COVID era, so in the last 5 years, it's more so that people have been exposed to it more to see the differences in the 3 different models and say, okay, well, I'm troubled, but why does that accounting put me in a different spot than if I've, been in one of these other paths? So is it, if TDR goes away, then is there one other single model that we go to that's not existing? I mean, I think that's where that, to your point, is it really an issue with TDR? Probably not. But then is the other existing guidance around modifications and extinguishments also the right answer? But I do think this was probably an area that, in pre-COVID environment, unless you had other going concern issues already arising, people weren't thinking about doing a TDR analysis. But that, as that shifted in the last 5 years, I think got to some, accounting answers that maybe didn't reflect the economic transactions. So I also, to the comment on interest expense and the gains and things, I do think from a cash flow perspective too, the way most of our smaller businesses and private companies are looking at that is, what's the impact to my tax return? What's the impact to my cash in bank? And we can kind of figure out what the rest of it means if it's a, on paper gain, or that impact to kind of the non-cash expenses, if you will.
John?
Yeah, so I just wanted to step back a little bit and give a summary of what the TIC has discussed on this over the last couple days and in answering the agenda consultation. So in addition to our being in favor of eliminating the TDR guidance, we have been generally in consensus in favor of more of a unified model for debt modifications, at least for private companies, whether that's a larger project within the framework or a separate PCC project. It sounds like that's been something that's in their ear right now, that they're considering a project already. But we feel like there might be a way to address some of these accounting concerns about the gains and losses that as we've discussed, and maybe find some solutions that will benefit private companies and make sense for them going forward, and remove some of that burden and and improve the decision usefulness of that information.
Christine?
So based on the discussion, it sounds like TIC would recommend, if we were to eliminate the TDR model, that it would just be eliminated, that there wouldn't be an option for private companies to say, I either want to apply the existing TDR model or follow modification extinguishment accounting. Is that correct?
Yes, I think that would be our
Okay.
position. I think adding in another optionality, reducing comparability even more, would just be confusing for preparers and users.
Okay. So then my second question, so then that would be a recognition and measurement difference. And sometimes we struggle, having differences in recognition and measurement for private entities versus public entities. So would the TIC members have any thoughts on whether, to get this through, you would recommend it's something that would also then be applied to public companies, so the public companies would also be recognizing potentially that big upfront gain with large amounts of interest expense afterwards?
John?
Yeah, I don't know that we're making that recommendation, but we are for private entities at least. And if it's something that would make sense to explore for the public arena as well, that would be something to explore maybe.
Jessica?
I think that's maybe a good question, as you look at the feedback that you received from the agenda consult, what was the public company view kind of there? Because again, that's not really our wheelhouse, but I do think there was if TDR doesn't exist on the lender side, does it make sense to exist on the borrower side still? So, and that was not private company specific too. So I think that's part of the consideration, just looking at the overall feedback from this agenda consultation is that, we're representing the view of the private companies, but again, to your point, is this an area that does make sense globally to look at?
And we acknowledge that we know this is a very hard area for standard setting. It's a reason that it comes up, I think, a lot in these agenda consultations is there's so many interrelated parts to all of it of trying to fix one problem. You sometimes have unintended consequences that could end up being worse. And so we recognize the challenges associated with all these interrelationships with debt.
Yeah, could be really easy if we just said it. They're all extinguishments, but that probably wouldn't be really popular. Yes, understand.
John?
If we're moving on from that topic, one of the other priority areas that we had asked about and just curious to get your feedback on was the definition of a public business entity. Our two specific areas or parts of the definition that we thought might warrant some attention are conduit bond obligors that have securities traded, listed, or quoted on an active on a market or exchange over the counter the market. Those are currently treated as PBEs, even in cases when the investors do not receive the financial statements. We encounter in private practice scenarios where those financial statements are not required by the investors anywhere. They don't go into the public space. And so that puts a burden on those companies to have to apply all of the early implementation, effective dates, and all that goes along with that. The other recommendation was to also consider SEC registered non-issuer broker dealers, kind of in the same thought process as when their financial statements don't go to the investors, to the public, that the user group is a little more similar to a private company. And so again, if we can reduce the burden on them and alleviate some of that, that would be an improvement in our view. But curious to get your feedback on what came in on that.
Tiffany?
Thanks. Yeah. So I guess I'll take it in a couple of different ways. So we did hear kind of what I would call mixed feedback on the definition of PBE, but maybe with a larger bucket in the middle on neutral, whether, the board moved forward or not. I think there was a couple of concerns highlighted by stakeholders on both sides. So we heard, John, very similar to your point of view on the bond conduit obligors and on the non-registered SEC broker dealers, that those being in the definition of a PBE today can be costly, and they do question the decision usefulness of that, given that the users tend to be either a narrow group at the SEC or just, internal owners of the company. So that was heard. And then another point that we heard there was sometimes in transition, we will scope out things and say, bond conduit obligors don't need to adopt with SEC registered public companies. They can adopt with private companies. We heard that distinction can be confusing when we make it. And then we've also heard that, don't quote me, but I think there's 10 plus definitions that we might use related to a public business entity or a private entity. And stakeholders said that can be confusing as well, because sometimes you're in the scope of one topic, but you're not in the scope of the other topic. But I think taking all those issues, if you will, related with the definition of a PBE, the one major concern we heard was, if we do change anything, does it cause unintended consequences or does it make it more complicated? So there was a little bit of, if the board moves forward, just we caution you on not making it worse, make it better, is what kind of the feedback was. Sorry, that was maybe a little blunt for the board members. Okay, some board members liked that.
Thank you for that. I think maybe the last topic, or maybe we have two more, but I think the definition of common control was another one. I don't think we had it as a high priority, but it was one of those that we debated whether or not we would have it as high priority, just because it comes up a lot with private companies, especially now as there's more situations where it can impact recognition and measurement with some of the leasing and VIE considerations around common control being different than just related parties under common ownership, and just the feedback you may have gotten on establishing a definition. And again, we do acknowledge on this one, we know this has been looked at multiple times before to try to establish a definition, and that there's a lot of challenges, and kind of played in that same vein of trying not to make things worse by establishing a definition, and whether another alternative might be to provide some implementation guidance as far as examples of what might be common control without drawing a hard line definition. Erica?
Yeah, I can I can share some of the feedback we heard. So I think very consistent with what you just summarized. I think there were some that thought it would be helpful, it would improve consistency and comparability to create a definition. But I think there were some critics of whether that could be achieved and whether common control could be there, and that there's no significant practice issues in applying current guidance. There's sufficient guidance. And I think some also said that challenges really arise from complicated transactions rather than the lack of a definition. So I'd say overall, that's what we heard. So, it wasn't like the bottom of the lowest topics, but I'd say it's just some were skeptical that there could be a solution.
Jessica?
I think in practice, when there's a private company alternative or election that's based on, 4 entities under common control only, that causes confusion with our, the client base that are, if we have a related party, I think they tend to think common control equals related party and it's all the same. And so it's, to the point of implementation guidance or education on, it's really hard to say, well, this standard applies to entities under common control. And then when someone asks, well, what's the definition of common control? There isn't one. That's, obviously where this is stemming from, but also knowing, well, we don't want the definition of common control that's so narrow that then we aren't able to apply those exceptions or practical expedients. And so I think that's just where, for more clarity, that's probably why the feedback as well was kind of like, we want this addressed, but we don't want it addressed in a way that actually makes it harder for us, because then we can't elect some of these things that are intended to make our life easier. But we personally in our firm work with there's a lot of related party transactions, a lot of, related party where they're not under common control, and having those discussions with the preparers is where this comes up to say, well, how do I then justify myself into being common control relationship versus just related party relationship so that I can get the accounting outcome that I want? And I don't think that that's what the intention of the standards would be.
Rich?
Yeah, and I don't know if the TIC members have come across this, the general definition of common control and the simple transactions don't seem to be the issue. It tends to be more the definition of a control group. And where did that come from in our accounting standards, right? Do we have a control group definition? And people sometimes not finding out there was such a thing as a control group until somebody else pointed it out to them. So just curious, is that something that you see? It might be more in the private equity space that it occurs, but that tended to be the definitional issue that at least I'd heard.
Yeah, it's certainly not the easy transactions. It's more of these more complex ones, especially as private equity has gotten more prevalent. There's more and more related parties. So trying to figure out what is a control group. And so, again, that's where, as we were writing, I think we included in our letter, it may be something to where maybe educational materials like a staff education paper or implementation guidance might be something that could help, more so than a definition, because definitions get put in place in some of these and then it becomes black and white, and then it can still be hard to apply in some of those instances. maybe now I think this is our last one. For for the disclosures, I think we heard this come up in the PCC, and I think just really like the way it was phrased in there. I think maybe Rich, by you, is just, I know you got the feedback of enhanced disclosures received quite a bit, but outdated disclosures also received quite a bit. So just, I think the board's been doing a good job of this, but just as these, looking at disclosures of really making sure from a perspective of private companies, evaluating which disclosures make sense for private companies, given that their users often have more access to management and the needs of investors and public companies are often different. Just keeping those considerations in mind. Jessica?
Kurt kind of stole my note here on that, but we were sitting next to each other earlier, so I think we have the same notes. I just wondered, I know you had mentioned when you were talking about what disclosures were brought up, I think in kind of the outdated disclosures, it was the topic 820 fair value and 815 with derivatives. But I know in the questions in the ITC had some like, are there other areas that you are interested in? Was there a consensus kind of on other disclosures? I think private companies in general are like, let's disclose as little as possible that's still useful information for our users. But so it's not, I think that's where you see here that we had it kind of as a lower priority, because it's like, obviously we value the disclosures and want to make sure that the disclosures are clear and we have the right information in there, but balancing that with anytime I think we see enhanced disclosures, it's like, well, how many more pages are we adding and is that information relevant? So I just wondered if there was other outside of the items that were specifically listed, if there was other areas.
Tiffany?
Yeah, so there was, I'm going to do enhanced and outdated together because I feel like you can't talk about one without the other. So the feedback really on enhanced came from investors asking for more. But the one thing that's interesting about that is that some of that might relate to other projects. Like on hedging, they might say, I want more meaningful disclosures there. But on hedging, we also heard at the same time, certain disclosures don't make sense on hedging, like the notional amount if you hold more than one hedged instrument. So we heard some of that. Then on, say, like fair value, folks are saying, I might want more meaningful information about investments and sensitivity there. But then folks are saying on fair value, sometimes the level 3 disclosures don't make sense when I hold a whole lot of level 3 investments. So it's kind of a push and pull that both sets of stakeholders, whether preparers or investors, they want to provide, and they want guidance that provides the most meaningful information. And how you get to that, I think, is where the diversity and the feedback is. So there's a lot of push and pull between both sides, but I do think it's kind of weaved, the theme of disclosures is weaved throughout all of the 40 plus topics for the most part.
Did somebody else have, I'm just gonna go green. Did they have any specific areas though of disclosures besides those that you mentioned that they like targeted asks of if you were going to enhance?
They did. So yeah, if you were going to enhance, they mentioned enhancing disclosures around more income statement information. So wanting more disaggregation there. I think there is an interplay between wanting to make the statement of cash flows more meaningful. So looking for more meaningful cash flow information. There's always more interest in what I would call business combination and pending transactions. So investors are looking for more information about how a pending transaction might influence future revenue. So more along those, I wouldn't say that I was surprised by any of the disclosure feedback at all. It's kind of very consistent with what we've been hearing over the years. So that's really kind of where it was, but I would say it does weave its way into all of the topics.
And I guess I'm making an assumption maybe, but do you know, like in that investor feedback pool, was it primarily like public company kind of, or was it a mix? Because that's where I think when we were just wondering, like, is that information similar? I mean, obviously statement of cash flows for sure, but some of the disaggregated income statement items, it's like, what was the investor group that was asking?
Yeah, I mean, I think some of the investors that we did outreach with, some of them focus on more smaller companies, some of them focus on larger. So I would say it's kind of a mix and where the feedback is. I would say definitely from the private side, preparers are concerned about adding more pages to the financials. So I think that was kind of consistent with your feedback. But I do think there is a theme that we did hear in a couple of letters that, private companies have a lot more private equity investors, and they don't sometimes have that access to management that you have in a traditional private company. And there is some concerns there as well on sort of that access to management. It's not as we used to see maybe 10 years ago.
Tiffany, you also did a lot of outreach with lenders, right? And the lender community that would deal with the private companies.
Erica?
Yeah, I totally agree with what Tiffany said. I think it was very mixed. I'd say it wasn't necessarily one public company versus private company. There was a whole laundry list of disclosures that were suggested, as it was in the ITC in itself. There was a big laundry list, and there was also more outdated disclosures that were addressed too, such as VIE disclosures and others. So I think there was the disclosure topics as a whole was a wide volume, including ESOP repurchase obligation disclosures, which was actually a separate topic in the ITC, which was one that the PCC has kind of flagged as a top priority over the last few years. So wide variety, I'd say, and diverse.
Sheila?
It seems to me like some of what you mentioned for enhanced disclosures is, I think, a market want for understanding better how risk or certain risks could impact the financial statements. So my comment would be just being careful and meaningful about what are we talking about? Is it, is it something that's not to go into auditing standard, but is it something better that's presented as supplementary information or unaudited information or things like I heard you say, like sensitivity, for example, some of that might be a little harder from a financial reporting perspective, but it seems to me there's an underlying sense from users to want to understand better how risk may impact the financial reporting. And so then is that best dealt with from like a critical audit matter type thing versus financial reporting? So just from that perspective.
Rich?
Yeah, and maybe just a request from TIC to the extent you think we aren't hearing from investors or lenders that you're hearing from, please get them in touch with us, because we spend a lot of time doing outreach with private company lenders, with any private company capital market participants that we can get to. But if you think what we're hearing isn't reflective of that, I'd encourage you to get those people and ask them to please talk to us, because we're in search of them, and we're sharing with you what we hear. If you think it's something different, it would be great to hear from them.
Jessica?
Yeah, I think it was more just an understanding, since we were in, direct conflict with, this is a low priority area maybe for us, but for them. And I do think, the point out of it's more private equity owned where you don't have that direct access to management. I mean, that makes a lot more sense that they would want the more transparency. Plus, I think I've done enough with the fair value disclosures over the years to know that I would like that to change too. Not a TIC position, but a personal position, that just to make it it's more relevant to what the users actually need.
Katie?
Yeah, just one more quick comment on one of the areas you mentioned about BizCom and pending transactions and the potential future impact. I think that's would be hard to include information such as that. So that just worries me a little bit to hear about that. I think that would be difficult to incorporate from an audit perspective as well. So.
All right. I think those were all the items we had. And so thank you again to the staff. I think that was very helpful understanding everything. And also, we know that the board and the staff work closely with the PCC, but as you're putting together, I know there's a lot of work in front of the staff as we see all these different items that feedback was provided on. If there's anything that TIC can do to help, if you have questions about the private company viewpoints, we're always happy to get in touch with the staff and provide any insights that we can. All right. With that, we'll get ready to turn it over to Katie to talk about a topic that TIC just wanted to bring before the board as far as related to newly formed entities that are not joint ventures.
Okay, as Kurt mentioned, this was a topic we wanted to present and get your thoughts. So this is going to be concerning entities that are newly formed that don't meet the definition of a joint venture. We noted that ASU 2023-05 is very helpful and provided clear guidance for accounting at formation for entities that do fit that JV definition. But when they don't, there doesn't seem to be clear authoritative guidance on how to account for those net assets contributed at formation. We did know preparers often analogize to fair value, but that's not always the case. So that can lead to inconsistency and comparability issues. So some ideas that we wanted to present were perhaps some targeted implementation guidance to reduce that inconsistency and increase comparability. And perhaps consider revision or refining of the JV definition. Next slide. And to provide an example of what we're talking about here, take the case, you have three companies forming a new entity A, perhaps opening a new manufacturing facility, some type of new product that they're developing. And what we have really feels and looks like a joint venture, but it doesn't quite fulfill the definition. There may be joint control, but maybe not active joint management between those companies forming the new entity. They may not all be mutually benefiting or sharing in the risk and reward. So again, it very much feels like a joint venture, but depending on how narrowly or broadly you interpret that definition, it may not fit into that bucket. And then, of course, like I mentioned, then it's unclear, are we using fair value to account for those net assets contributed, carryover basis, or perhaps something else? Next slide. So the three questions for discussion we wanted to bring up were, first, does the board distinguish a significant difference between an entity such as I just described and I would say a true JV that fulfills that definition in full? Is that there does seem to be a disparity in practice between those applying a broader definition and a more narrow definition of what a joint venture is? And could implementation guidance be helpful here? And thinking about the joint venture definition, would making that a little more inclusive be helpful? Could that lead to unintended consequences? Kind of what would be the pros and cons of something like that?
Thank you, Katie. Rich?
Just curious, I know this is the NewCo. Do you see any diversity in practice from the ventures accounting, meaning they're contributing assets getting a non-controlling interest, right? I presume they're accounting for it at fair value. Is that pretty uniform? All parties doing it at fair value?
From what I've seen, it is.
It is.
Yeah.
So then it really just comes down to the NewCo. Does somebody decide they want to force an analogy to BizCom accounting?
Right.
Or do they recognize, no, that only applies with businesses?
Mm-hmm.
And you don't necessarily have to identify an acquirer. You can view it as a newly formed entity. Thank you.
Yeah, and so I think it's just there's been a little bit of diversity. I think the joint venture definition project, I know it was intentionally narrow in scope and it's been very, very helpful, but it's kind of brought about that there's a bit of a disparity where some take, as Katie mentioned, a narrow view of that definition, whereas others take a broader view of that. And so then you can, depending on that viewpoint, you can have very similar entities that may or may not be considered a joint venture and then potentially different accounting in those instances.
Or don't ask a BizCom person because they'll tell you have to identify an acquirer, right?
Yeah.
So know your audience, right?
Mhm.
Okay. I mean, I think it's a fair question, but
All right.
that's me. I'll just, sorry. You got one vote. It's a new basis of accounting, though, is kind of like our third rail, right? NewCo accounting. When do you have the NewCo? When don't you? But I certainly understand the question. In the JV standard, some of us thought the accounting for the venture partner being at fair value was a significant driver to how the venture should account for it. Just others might not have weighed that as much, but some of us did.
Christine?
Yeah, I guess I would just echo Rich's comments. I mean, I think it's a very fair question, and it is one that came up most recently in the context of Update 2023-05, and we made the decision. I mean, we talked about the definition during the course of that project, but we're concerned, I think, at the time that taking that on would slow that project down, and it was somewhat outside of the scope of what we were trying to do in that project. But over the last 10 years, while I've been on the board, this issue has come up several times, and there's not been enough of a groundswell to take it on, but I don't think that indicates that there isn't an issue. So maybe you guys can begin the groundswell.
Sue?
Yeah, certainly I have a lot of similar recollections to Christine, and certainly I think I was one of those in the camp that would have loved to have revisited the definition, just because in practice, it's my experience is that there's an inconsistent application. But no, so you have my vote on that too.
Yeah, we don't know if we all vote the same yet, but that's a different issue.
All right, well, I think that was the last item that we had on our agenda. So if there's no other questions, again, we just want to thank the board for letting us come out here and provide the feedback that we have, and for the staff for the presentations, the materials provided in advance. It was all very helpful. That, I think, meeting adjourned.